So what next for interest rates in 2025, and what do you need to take into account as a UK property investor? But first, if you're new to this channel, make sure you subscribe and hit the bell icon. We put out new videos each and every week, all dedicated to keeping you on top of your property investing game. Now, at the beginning of 2024, things were looking quite good. In terms of inflation. Inflation was coming down. It reached a low of 2.1%, which is tantalizingly close to the Bank of England target for inflation, which is 2%. Now, basically, the Bank of England sets interest rates. They have a relatively blunt instrument, which is to look at the inflation figure. If inflation is way above 2%, then the Bank of England is tasked to bring that down a little bit. And the only tool it has at its disposal is to set interest rates. By setting interest rates at a higher level, it takes a lot of money out of the economy and therefore brings down inflationary pressure. So as inflation was coming down, that's why the Bank of England had some headroom to reduce interest rates, and interest rates were widely predicted to go into 2025 and head for around the 3 to 3.5% type of level. But that all changed, of course, with Rachel Reeves' October budget. Of course, Rachel Reeves, from her CV, is an economist, so she would get the budget right, wouldn't she? But her glorious CV wasn't enough to convince the markets, and they thought otherwise. Now, of course, inflation is predicted to go up. And quite frankly, that's such an obvious prediction to make. Because in the budget, Rachel Reeves launched this £40 billion tax raid to basically put up employers' national insurance contributions. Now, the Labour government, during the election campaign, had locked themselves into a corner. They said they wouldn't increase income tax, they wouldn't increase VAT, they wouldn't increase corporation tax. There wasn't really much that they could do. So the only thing they could do was really raise employers' NI. But everything has a cost. And that employers' national insurance hike means that the cost of products and particularly services will go up. It also, of course, means that certain people will be laid off and people will not necessarily be hired in the same numbers. It also has a downward pressure on wage growth as well. But you'd be very surprised that Rachel Reeves, who of course her CV says is an economist, wouldn't have figured this out, that raising the cost of employing people is naturally going to raise the price of goods and services, therefore creating inflationary pressure. So the predictions for next year in terms of inflation, that's edging up a little bit. Growth predictions have been revised downwards. The Bank of England predicted 1.5% before the budget, now that's down to 1.2%. And what all that means is, of course, the Bank of England has less headroom to play around with reducing interest rates without causing more inflation. Now, the markets see that, in particular the swap markets, and that's why what we've started to see in recent weeks is that fixed rate mortgage products have started to edge up a little bit. At the beginning of the year, they thought interest rates were going to come down. Now no one believes they're going to come down as fast as they thought they may do 6 months ago. So if you've got buy-to-let mortgages on some of your existing properties and you're looking at switching them into fixed rates, I'd probably look to make those decisions sooner rather than later, because lenders seem to be on a daily basis deciding on what to do with their rates, and as they're bringing out new products, those tend to be edging up a little bit. Now, I think one thing all this teaches us is that predictions are exactly that. They're predictions. It's crystal ball gazing. And when you make a prediction, you do so based on the circumstances that you know about right now. So before the budget, people were making predictions based on those, on knowledge as at that time. And that changed in an instant. So my view has always been to go for fixed rates as opposed to floating rates for buy-to-let property. And try to go for long-term rates such as 5 years. And look at the rate that you're being offered today. If it works for you today and generates rental cash flow today, then by locking that in for 5 years means that you know that your cash flow is going to be at least that for the next 5 years. Waiting a few months hoping for things to get better or interest rates to fall even more, can be a bit of a dangerous game because when people make predictions, they do so based on the best data at the time, but things can change. So it's not just events like the budget in the UK that has an immediate impact on interest rate direction, it's also what happens overseas. And the most significant thing that's happening overseas is, of course, Donald Trump's election in the US of A. Now, he hasn't even taken office yet. He's just been appointed, but he's already done or indicated his direction of travel as to where he will be taking the US economy, and we have seen already the dollar strengthen against the pound. And what that means, of course, is that all things that are priced in dollars, such as oil and plenty of imports, are going to get more expensive as the pound weakens a little bit. And of course, that will add inflationary pressure, which gives the Bank of England far less room for manoeuvre in terms of interest rates. So to sum up what we're saying, interest rates in 2025, they ain't going to be on their way down quite as dramatically as what we were thinking they would be in the first half of this year. In fact, the interest rates in 2025 could even go up a little bit, particularly if the pound weakens against the dollar and that causes more inflationary pressure here at home. So if you agree with me that that is the direction of travel, your best bet will be to think about fixing into 3 to 5 year interest rates on your buy-to-let investments. The Baker Street Property Meet is the UK's largest and #1 property investors networking event. The property market is going through monumental change right now, and at Baker Street Property Meet we aim to keep you up to date with the latest tips and tricks and insider tactics to help you keep on top of your property investing game and succeed in these troubled economic times. The Baker Street Property Meet is fundamentally about networking, because it's not what you know, it's who you know. And at Baker Street we aim to connect you with the people to make your property journey a monumental success. There's no better place to be to further your property investment journey than the Baker Street Property Meet. So make sure you're here, you're connecting with myself and Andrew Roberts, our expert guest speakers, and 300 passionate property people each and every month. See you at the next meet. Get your spot at bakerstreetpropertymeet.com.